Is this the most powerful bullish continuation chart pattern? Is this the most powerful bullish continuation chart pattern? Good morning, good afternoon, good evening, bonjour, bonsoir, mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW24 traders, and our website is www.stochastic-MACD.com. The title of the video is this the most powerful bullish continuation chart pattern? All right. Recently, I have started recording videos about chart pattern, double top, double bottom, inverted head and shoulder chart pattern, head and shoulder chart pattern, how pro traders can trade those chart pattern like a professional traders. All right. A lot of traders know about chart pattern. They know about the theory about a chart pattern. But when it comes to real trading, how one can use the chart pattern to trade like a pro, a lot of traders will find it a bit challenging. Today, I want to share with you the most powerful bullish continuation chart pattern, the cap and handle chart pattern. Now, as I mentioned that name, a lot of traders will quickly switch off or go and watch another video because they already know the formation of the cap and handle chart pattern. But what I want to discuss with traders today is not about the components of the cap and handle chart pattern, cap and handle chart pattern. I want to go a little bit deeper about the practical trading when we are talking about, the cap and handle chart pattern, a powerful continuation chart pattern, So I recommend to traders to watch the full length of this video so they may understand how to trade the cap and handle chart pattern like a pro, all right? Let's get started, all right? So first thing first, when we are talking about a pattern, we want to know when and where the pattern is formed. Talking about practical trading or trading like a pro, we want to know where and when the pattern is formed, all right? The cap and handle chart pattern is often formed during a bullish trend. So that's the best place, that's the ultimate place, the primary place where we are likely to see a cap and handle chart pattern. A lot of traders know that, So they may say, John, what's new, all right? So the formation is very important for us to know where the pattern is formed. But when we are talking about trading, all right, a lot of traders will say, I know the theory and I know what is the cap and handle chart pattern. But what I always say to traders, when you learn about the theory, when we learn about the cap and handle chart pattern, we know the formation, where it formed, all right? There is another thing. We want to discount or separate, all right, the theory from the reality of the messy financial market. I want to show you one example before we go a little bit deeper. I want to show you one example. So I say to you that the primary place for the cap and handle chart pattern is during a bullish trend. So I have my drawing here. You see the price will go up like this and then will form a round bottom because I can't draw it very round here. That's why I make it a kind of V here. But see this as a round bottom. So the price will go down first. Very round, as you see here, it goes down, very round, and turn around, So we see the round, but this is the cap, all right? Then we have the handle. The handle is the pullback. There is a pullback here. I'm going to show you here on this chart. There is a pullback here. You see the price pullback here. So you will see that the price was going up first, So the primary place is during an up trend. So price going up like this, and then we'll go round, beautiful round, bottom will be formed. This is what I put here like a V here, all right? So it's a round bottom, which is forming the cap. So when we are talking about the cap and handle chart pattern, think of a tea cup. Do you drink tea? All right, the cup of tea, all right? So a cup of tea, all right? A round bottom followed by the handle. The handle is this pullback here. So if you follow my drawing here, there was a bullish progression. Then we have a round bottom and a handle, which is a pullback again before we see the continuation or the resumption of the prior trend. The prior trend is bullish. So this is one of the continuation pattern. In fact, it's one of the most powerful continuation pattern because it's often formed during a bullish trend. All right, it makes sense? All right, you get it now? So we know where the pattern is being formed. The component of the cap and handle chart pattern is, we have two components, the round bottom plus the handle. So we can divide the round bottom into two. So the first part of the round bottom, we see price going down, okay? The second part, price going back to the starting point. So this will form a round bottom, okay, which is the cap here. The second part or the second component of the cap and handle chart pattern is this pullback here, all right? Now I'm going to go a little bit into the theory. According to the theory, the handle of the cap and handle chart pattern, the handle, shouldn't go down beyond the 61.8% of the height of the cap. So this is the cap here. What is the height? It's from the top of the cap to the lower part of the cap. So in the theory stated that the handle of the cap and handle chart pattern shouldn't go down beyond the 61.8% Fibonacci retracement level of, okay, the cap. Why? If you know about the Fibonacci retracement, so if the price goes down too much, okay, after a bullish progression, is indicating to us that that bullish progression is diminishing. That's why we don't want the handle to go beyond the 61.8% level. You understand? So we don't want it to go down all the way here. We don't want to go down up to beyond the 61.8% Fibonacci retracement level of the height of the cap. Because if it goes down too much, it's telling us that the bullish traders are losing it, are losing the fight, okay? So we want it to be a little bit above, at least above the 61.8% Fibonacci retracement level of the height of the cap. This is the theory. I'm going to show you different examples, and you will see that in a messy market, things are not exactly what, okay, we have learned in the classroom, all right? But the reality of the battlefield, so to speak, is completely different. All right? So pay attention carefully to what we are talking about. So the first condition is that we must see a bullish progression. So here it is, the price went up. And then we see the first part of the cap and handle pattern, the cap being formed, which is quite round. Sometimes traders will say, in a theory, they will teach traders that it must be perfectly round. It's not always perfectly round, my friend. Usually, here it's a little bit round, but I will show you many examples very soon, and you will see that it's not perfectly round. You will see very often in the shape of V like this, okay? And you will see sometimes that the handle will go beyond the 61.8% level, but generally speaking, shouldn't go beyond, which is normal, telling us that the bulls are still in charge. We don't want it to go beyond the 61.8% Fibonacci retracement level of the height of the cap. It's a powerful continuation pattern, the cap and handle chart pattern. So now, how traders, in the theory, what you will learn on the internet is that they will tell you that if the trend line, the price break out of this channel, here you see the handle, the channel, this bearish channel, that here, if the price breaks out and close above that, okay, channel, here it is close here, price was forming a handle and then turn around here and come out of this bearish channel, you must buy. Okay, if you are option trader, yes, you may buy using call option and hope that everything is fine. Okay, that okay, you are not your option, it does not expire before you get paid. But I will teach you a better way to trade it. You'll also learn that the most conservative way to enter this trade is above, okay, the neckline of the cap and handle chart pattern. So what am I calling the neckline is the horizontal line that is joining the two top of the cap. You see the cap here, we have one top here, another top here. So the most conservative place to buy, which I agree with, is when the price, validated the neckline as a support level. Here we can buy because the price breaks above the cycle point. So if you have been following now, you know what we call a cycle point. When the price goes down, it turns around and return to the starting point. This line here, the neckline, is a cycle point. So a bullish chart pattern above the cycle point or a higher low above the cycle point is a bullish trade setup. Okay, this video is not about the cycle point. I just mentioned it to you. Okay, so now we know. But what I want you to understand, the first thing first, bullish chart pattern, are formed either at a support level, at the end of a downtrend and during a bullish progression. Do you understand? So we can see the cup and handle chart pattern in the support zone. So if we see it, price goes up, and then we see it is formed at a support level, at a key level, we will give it a chance, If sometimes a lot of traders that are more in theory will say to me, John, you will never see a cup and handle chart pattern at the end of a downtrend. Well, maybe you are not looking far. I have one example here. This is electronic art. If you play games, electronic, they create beautiful game, electronic art. So play their game, beautiful game, racing game. Check electronic art. This is their chart here. And we have a cup and handle chart pattern at the end of a downtrend. Can you believe that? So the theory stated that is always during a bullish progression. Now you see the reality of the messy market at the end of a downtrend. We can see that the price form a round bottom. It's not perfectly round, as I show you that. The reality, you won't see very often perfectly round. But if you are reading on the internet, they will tell you that it must be perfectly round. But I am telling you now, it can be round, perfectly round. It can be in the form of V or round bottom. So when I'm talking about a cup and handle chart pattern, all I'm talking about is a round bottom. Round bottom, V bottom, cup and handle chart pattern. I do not make any difference between those patterns. And you understand why at the end of this tutorial. So here it is. There was a downtrend. Price form a kind of double bottom here, which is a bullish chart pattern at the end of a downtrend. That's why we usually see a bullish chart pattern, end of a downtrend at a key support level, and during a bullish progression in a rising channel. But remember what I said to you also, do not discount the theory. The primary or the ultimate place for the cup and handle chart pattern is during a bullish progression, Don't forget that. But here it is. We have one example here. Price went down and then form a double bottom pattern and then form a round bottom here. Form a cup and handle. Look, there's a handle here. Pull back, yes or no? Did he pull back, yes or no? Yes, he pulled back. So we have the round bottom and we have the pullback here, which is not beyond, the 61.8% Fibonacci retracement level of the height of the cap. Here it is. So here it is at the end of a downtrend. Here it is, we have a cup and handle chart pattern, and trader will use, the height, professional will use the height of the cup and handle chart pattern, and will project it at the top of the neckline of, the cup and handle chart pattern. Trader will say to me, George, no, that's not where they put it. Now, remember that not all traders trade the same way. So this is another thing I want to clarify with traders, because when traders are using chart pattern or they learn about it, they think that all market participants are doing exactly the same thing. No. In practical trading, it's not like that, Traders do not trade the same way. They learn the same thing, but they do not trade it the same way. Some traders will set their target from the end of the handle, which means, as I was explaining to you on my drawing, after this handle, the bearish, the price breaks out of this bearish channel. That the price breaks out of the handle after this candle here, it's closed. We are the monthly chart. They will draw a line here and look for opportunity to buy. You can see that this was a good one because after the price breaks out on this with this monthly candle. So that we draw a line on the high of that candle. Look, the price breaks above that high of this monthly candle and retest it here, giving a swing trader, position trader, excellent place to buy. This is a higher low, what? Above what? The cycle point. A higher low above a cycle point is a high probability trading setup. Should click straight away. All right. So this is a cup and handle chart pattern at the end of a downtrend. But if you read on the internet, you'll never see that. So this is one special case. This is what I'm talking about. Okay. I have another example. The theory stated that the cup and handle chart pattern, okay, the handle should not go down beyond, okay, the 61.8% Fibonacci retracement level, which is okay because we want the bull to be in charge. So if the handle went too far, we will put a big question mark on that cup and handle chart pattern, which means we will become a little bit more cautious, all right? We will trade that cup and handle, okay, in a conservative fashion because the handle went down a little bit too far. But if you think that, okay, the cup and handle chart pattern, the handle should never go beyond the 61.8% Fibonacci retracement level, I have a good news for you. There are cases where the handle will go beyond the 61.8% Fibonacci retracement level, and then the price will turn around. So how do you handle that? Okay, I will show you. I have one example here that I want to show you. I will bring on now another financial instrument. It's Netflix. Netflix, okay, if you watch videos, okay, I have Netflix account so you can watch videos, okay, and you pay $6 or $7 per month and you watch a lot of videos here. So this is Netflix stock, again on the monthly chart. I need to mention to traders that this pattern very often you will see on a monthly chart. So if you are an investor, you are a position trader, you are option trader, okay, you want to take position, okay, for a long time, okay, you will find the cup and handle chart pattern mostly on the monthly chart. You can also see on the hourly chart, on the 15-minute chart. But if you want to remain in a market for a long time, okay, you will see, use the monthly chart. If you are applying this strategy, it's a powerful, okay, continuation pattern. Here it is, my friend. So we see a bullish progression for Netflix, as I was telling you here. So price went up from here all the way up here. So I'm going to color it now into green. All right, you see now, bullish progression. So we have our cup being formed. It's a round bottom, but so perfectly price form. Some to them say, Joe, this is a double bottom chart pattern. Okay, it's a bullish chart pattern, doesn't matter. It's round. It went round. So you start from here and went back to the starting point. It's just the definition of going round. So you go from the starting point, you go from A, and you return to A. It's going round. So don't see round as a shape. See it as a movement from the starting point to the starting point is going round, okay? So it's a semi-cycle, okay, or semi-cycle. Is my pronunciation correct? Semi-cycle, half a cycle, okay, probably going around in half cycle. So here it is, it formed, okay, here it is. But if you look carefully at the Fibonacci retracement level, the 61.8 Fibonacci retracement level is here of the height of the cup and handle chart pattern. So it's the height of the cup and handle chart pattern. And the 61.8% is the line that I'm going to color here into pink. So you may be wondering, Joe, why should I do when I'm trading, real trading, okay, buying and selling, okay, in the financial market, and I see a cup and handle chart pattern going beyond the 61.8% limit. Why should I do? Okay, draw the line that I draw here like a pink, all right, and then pay attention to the 61.8. So if it goes beyond that level, so there was a bullish progression, price go beyond the 61.8, allow the price, you are conservative cup and handle trader, you will wait for the price to go back above that 61.8% Fibonacci retracement level. And then you wait for a pullback. Did you see here? As the price turned around and went back above the 61.8% level, which is the pink line here, look what the price came and retested here I'm going to put it on the monthly chart. You see the tail of this candle, the price try to retest that level because the market want to validate that pink line, which is the 61.8% limit for the copper handle chart pattern as a valid support level, so they may be happy to buy at this point in time. If I place on my chart a vertical line here, pay attention to that vertical line, the black line. Hopefully, I can see it on the weekly chart, okay? Let's go to the weekly chart. Pay attention to my, where is my, this is my, you see my, my line, here it is. You see how, on the weekly chart now you can see that as the price went above the pink line, it tried to retest that level of 61.8% Fibonacci retracement level. Not only that, the price has displayed a higher low above the 61.8% level. So, for practical trading, day swing trading, position trading, day trading, when the candle goes beyond the limit of 61.8% Fibonacci retracement level, you can be a little bit patient and then wait whether the price will give you a higher low above that 61.8% level. You are not alone because a lot of traders will expect that. Here they are, higher low being formed above the 61.8% level, providing us with, high probability trading setup. These are not signal. I'm going to come back to that because we are using what? When we are talking about trading like a pro, we are using what? A top-down trading method. So from the setup, we go to the signal time frame, and then we go to the entry time frame. This is about trading like a pro. All right, without the top-down trading method, we are not trading like a pro. All right, so here it is. So here we have a bullish trade setup. Again, a bullish trade setup. All right, the trend line here is kaput. Here it is. But you can see also that you will say to me, John, where is the handle? Yes, there is no handle here. That's well spotted. So there is no handle here. So you will notice that sometimes, that's why I always, when I'm talking about a cap and handle chart pattern, whenever you hear me talking about round bottom, think of cap and handle chart pattern, think of V pattern, but always I talk about round bottom because some of the cap and handle chart pattern do not have a handle. You only have the cap. Why? If the financial instrument is very, very bullish, you may not have the handle, which is a pullback. Why? Because the financial instrument is very, very bullish. And also, generally, if the sector is very, very bullish, you may not see a handle, okay, when you are looking at the stock that are listed in that sector. You may not. This is one example here when you see Netflix was very bullish. So here it went down beyond the 61.8, but finally went back above it and start going up. And there was no handle at all for the cap at all. There was no handle. Normally, we should see a handle here. There was no handle. When that is the case, the reason is the cycle point. This is what I want you to understand. When a financial instrument turn around, start from A and return back to A and find a support above the neckline or the cycle point, the first higher low above that cycle point is a higher probability trade setup. Also, bullish chart pattern that are formed above the cycle point are high probability trading setup. So you see here the first higher low above that cycle point here. This is a high probability trade setup. Trader responded and bought, it went up. If we see also a bullish chart pattern above the cycle point, here we have a double bottom pattern. Here it's again a bullish trading setup. Now we have a triple bottom chart pattern. A triple bottom chart pattern is an invitation to buy before it's too late. Here it is, a triple bottom chart pattern being formed above this the cycle point. We do not have here, okay, the handle. Are you seeing how the theory, okay, is not always what is happening when we are talking about real trading? Here we have a cap without a handle. So trader will say to me, Joe, this is a V button, or this is a round button. This is not a cap and handle chart pattern. Great. We are speaking the same language, all right? You get it now? So this is what I want you to pay attention to. So as the price goes above the neckline, you see here we didn't have a handle. Trader will project the height of the cap to set initial target. Now, this is another thing I want to mention to you. When we are trading, okay, real trading, all right, not the theory, all right, not what is a cup and handle chart pattern, which you can read on Investopedia, on the web, and in different places, all right. When we are talking about real trading, all right, traders do things differently, all right, because money is involved, and the traders are managing a portfolio, all right. So they do things a little bit differently because they become a little bit cautious, and with the experience that they go through over time, they don't want to play around or lose, okay? So they do things a little bit different. So we are talking about initial target. Generally, when traders, especially new traders, start learning about chart pattern, they get into a scientific mode, which means they will say 1 + 1 = 2. George, you said to me this last time, must be always like this. But no, it's not always like this. Apart from the market stable data, okay? Those are the only things that remain intact in this market. But so when traders set the initial target, so they will say, this stock has a high chance, or market analysts will say, this stock has a high chance to go up to the level of $77, okay? So as the price was here and start finding support, market analysts will forecast that Netflix stock has a high chance to go to $77 while it was in around $50, okay? That's a market projection. But when it comes to trading, professional, we set the initial target here, which I'm going to color now into orange because we are talking about how to trade like a pro, all right? So they will set the initial target here. They will divide it into 2. So what do I mean? This is the initial target. They will divide it into 2. So I'm just quickly putting a line here. So the midpoint of our target, do you agree? Somewhere here. So they will draw a line there. So they will take the first profit around that zone. Can you see what has happened? The price, the initial target is here, but as the price reached the midpoint of the target, they took the first profit. Price went back again, midpoint, they took profit. That's why we see this movement, a consolidation between the cycle point and the midpoint of the initial target. So for a day trader and a swing trader, it's very important to understand what is happening, so you may also take convergence signal here. We can take contra trend here, carefully, carefully, carefully. If you don't want to take contra trend, or you are not in the mode of playing against the trend, you may position yourself somewhere here looking for bullish trend setup only. But we know that traders, some traders will take profit at midpoint, also providing us with another opportunity to buy at the midpoint. Look what the price did at midpoint here. Here was a good one. So it pulled back to retest the midpoint. Okay, conservative trader will buy above this high here. Because there is a resistance here, they can place order above this line to buy. So as the price finally reached the target, you see only few traders came out here because a lot of traders were coming out. They took half of their profit many times here already. So here no one came out again. This is the initial target without even a pullback. So price goes above the target. What the professional will do? They will project the height of the cap above the initial target. Once again, they will use the midpoint again, the midpoint. Look, as the price goes, look, am I talking to myself? The trader took profit here. Look at the shadow on top of this candle. Trader took profit here. Why? Because of the midpoint of the second initial target. That's why the price slowed down here. Finally, the price pulled back again to retest the midpoint of the second initial target. What do I mean by second initial target? The projection of the first target above it. So we have another target here. Remember, the first target was the orange line here. The second initial target is now here. So finally, the price pushed it again, reached the second initial target, and then pull back to retest the midpoint. Price turn around, in fact, form again a double bottom, a bullish chart pattern. So when the price is going up, and form a bullish chart pattern, this is now a market stable data, okay? When the price is going up and form a bullish chart pattern, that bullish chart pattern is a high probability trading setup, okay? So price went up, now we see a double bottom chart pattern, should click, it's a high probability trading setup. Because it's a bullish chart pattern after a bullish progression, it's a continuation pattern, price went up again, okay? Here they project it again. So now if the price goes above the second initial target, we'll project it again, bring it out somewhere up here. You can't see it. But what you look carefully, if you project only half of that target, here it is. You see where they took profit? At the midpoint above the second initial target. All right, you see now how the market, the price going from one key level to the next key level, one target to another target, the initial target to the midpoint. All right, you see now? And again, it's just going on. Price pull back again to the first initial target. Here it is. And now we are again above midpoint. It's all mapped out, my friend. It's all mapped out. This is where we are now. The midpoint of the second target. That's where we are now. There is another rule that I want to share with you. Okay, when we set a target and we project it 3 times, at the third projection, we consider the market as overbought. So generally, so if traders set a target first time, second time, and third time, if the price reach the third target, they consider it as overbought. Most traders would like to cash out at that point. If it goes beyond the third target, use the mid target above the third projections to set, okay, your target, okay? So you see now, so there are different variations when we are talking about cup and handle chart pattern, the thing that we learn in a classroom, and the reality of the battlefield of day trading, swing trading, position trading, and investment. So suppose you are a soldier, so their soldier will go in the classroom, they will show them what is a gun, what is about the arsenal they are using, they will talk about it in a classroom. But what usually takes place, the same thing is true in trading, all right? We go around, we go to website, okay? We learn the theory, all right? But one important point that traders are missing, all right, which I've noticed, okay, is the practice. So soldiers will learn the theory, but they don't go to the battlefield without a practice. But generally, what is happening in trading is that trader will learn something, and then they will go to the battlefield, and they get kicked out. Do not do that with yourself. What traders should do, you learn it, and then use a demo account, practice, all right? Master it, and then go to the battlefield as a competent soldier, so to speak. All right? So let's move on, my friend. I have another stock I'm going to show you here, Yahoo stock. I haven't finished talking about this cup and handle chart pattern. One of the most powerful bullish continuation pattern. A continuation pattern is a bullish pattern. A continuation pattern is a pattern that is formed indicating to us that a trend, that the prior trend will continue. So there are continuation patterns in a downtrend, there are continuation patterns in an uptrend, but a cup and handle chart pattern is a bullish, okay, continuation pattern that is usually formed, okay, during a bullish progression. What usually takes place, so the price goes up, financial instrument is bullish. So some investors think that the stock went too far and they should sell. So they cash out, they sell their portfolio and they come on. But professionals who understand, who are checking Google Finance, Yahoo Finance, okay, know that the stock have more to go. Or area wave trader that are counting area wave may know that the stock must go up more. So as the price pull back during the first part of the curve, the bullish traders are waiting to buy again because they know that the fundamentals are solid, the sector is solid, and the market itself is bullish. So they know that the stock should go up more. That's why we have a cup and handle chart pattern. The weak investor will cash out, and the long-term investor who understand how the market is functioning will buy again, forming the cap. As the price tries to go up, a lot of traders who sold it first, the price return back to the starting point. They think that the price will form what? A double top chart pattern. So look what's happening here. You want to understand what's going through the mind of trader. So as the price came to this point here, they are thinking of which pattern? A double top chart pattern. So they see a double top. But because they don't know that the stock has more to go, all right, they think that this is the end of the trend. But traders who understand area wave, for instance, know that when we have a strong move up, usually the trend does not end like this. All right? The price usually will go up again and form a new higher high. Okay? So, but you understand why we have the cap. As the price came here, traders think that a double top is in place. Okay, now we know how to trade a double top like a pro. The double top is information. So we'll say it's information here. All right? But the double top will be completed only if the price finds a resistance below the neckline of the double top. But here, traders are thinking of double top. So they are selling. As the price starts going down, the smart money continue to buy. And they position themselves near the 61.8% Fibonacci retracement level of the cap. That's why the theory stated that the handle should not go beyond the 61.8% level, because if there is a demand to buy, they would like to buy around that zone. So if the handle goes down too far, it means that there is no demand to buy at the best place, which is the 61.8% Fibonacci retracement zone above that level. So they say, be careful. But I just show you one example here of Netflix, which went beyond the 61.8% Fibonacci retracement level. But it is true. In normal condition, the handle should not go beyond the 61.8% retracement level. So what is happening, the reason why we have the handle is because traders are thinking of double top and they start selling here. Price went down a bit. So if these swing traders that are thinking of double top do not cash out, they will be kicked out of their trade as the price is resuming the trend. Okay. All right, here it is. I'm looking at my Yahoo stock. We see again a bullish progression, a round movement. So this is not perfectly round. You see, it's not perfectly round. Is it perfectly round? It's not perfectly round. That's what I say to you, I think of V pattern. So here you form a kind of V, and then we see again the handle here. So for Yahoo stock, we have a handle. Are you with me? See, this handle went a little bit far. You can see that the price form a tail all the way here. If we measure, okay, the height of the cap, we can use Fibonacci retracement level to see, okay, how far, okay, the handle went. So you can see that this handle went to exactly stop. You see here, it stopped at 61.8. Let me show you, okay? It stopped at 61.8% Fibonacci retracement level. 61. Can you see on my chart? Pay attention to my cursor, 61.8%. That's where it stopped exactly on the down. So we have a round bottom or a V pattern, all right, or a cap here, followed by the handle that brought the price into the 61.8% Fibonacci retracement level, and then the price went back above, okay, the cycle point or the neckline of the cap. Okay, so in that case, professional will use this measuring stick to set a target for Yahoo. That's exactly in that zone that Yahoo stock start coming down. So when the price reaches the target zone, a price target level, what should you do? You will go to Google Finance, you will perform Google Asset test, you will check the financial, you will check the market itself first. What's going on with that stock? If nothing is going on, and they are struggling, there's a high chance that the stock will go down. I need to clarify something very important here. The natural progression of the financial instrument is bullish. The price wants to go up. It's normal, okay? Wants to go up every day. For a financial instrument to go down, there must be a reason, fundamental reason. Do not sell for long term, medium term, if you do not have a fundamental reason. Use a cycle, use Elliott wave, okay, to determine when a financial instrument is likely to come down, okay? So here it is, Yahoo reached the target zone. At this point in time, we'll be watching this place and monitor what's happening here. This is a beautiful setup, by the way. Look, the minimum price move is what? Is free. So it went down one, this beautiful one, and then went up again. So we will say minimum price move is free. So as it's coming down, if it doesn't form a double bottom here, which it did not, and now here it is, a free. 1, 2, 3, all right? Here it fell. So we can carefully trade this, okay, without losing, okay? You see now? So this is another, okay, cap and handle without a perfect round, okay, after a bullish progression. Price stopped exactly at the target point. You can see that the price did not even stop at midpoint in this case, as I was telling you, but it went directly to the target point only to crash back down. Okay? I have one more example I want to show you so you may understand once and for all right, what is happening when we are talking about, okay, a cap and handle chart pattern. What I will recommend to TSTW24 traders, you can look for cap and handle chart pattern on a daily chart, All right, and then you will go to the first best time frame, okay, to trade it. Okay, now you know what is the cup and handle chart pattern and how professional trading it. You will find excellent cup and handle chart pattern on a daily chart or 2 days chart, which I prefer, and then you will switch to the first best time frame, okay, looking for, okay, a signal, okay, it makes sense. TST-WSY is usual traders. We will also look for a cup and handle chart pattern and then use the TST-WSY as usual a trading system to trade it. Here again, you can see that we have a bullish progression, right, from a V pattern. And now we have a cap that is quite shallow. If you look carefully here, this is a quite bullish strong, a bullish stock. You can see that the cap is below and we have a higher low above the cap. This is the cycle point and we have a higher low, okay. Here it is, right, from a higher low above, okay, finding support above, okay, the neckline or the cycle point. The price did not come down to form a proper handle here. This is one example of a very bullish financial instrument. In fact, this is ABCD chart pattern, okay, that we have here. The A, B, all right. So A, B, C. The B to C is what we call it. We have here a bullish chart pattern, which is a cup and handle chart pattern, a special one. When you see that, okay, the handle did not even go inside the cup at all, okay, above it. And then we have, okay, the next move here, A, B, C, D, all right? And the B to C is a cup and handle chart pattern, which is a continuation pattern here. So one example again here, which is completely opposite to what is taught in the classroom, a round bottom with a handle that is above, okay, the neckline or the cycle point. This is what we're talking about, the reality of the financial market. So I want to show you all this example so you do not go around saying that a 1 + 1 = 2. This is what is said. This is always what is taking place. So you do not miss excellent opportunity and you may understand exactly why the handle is formed. The handle is formed because traders are thinking of a double top as the price hitting this point, as the price pulling back, the price finding a support near the 61.8% Fibonacci retracement level of the cap. For financial instruments that are called bullish cow, so to speak, or financial instruments that are dynamically bullish, you may see that the price may not form at all a handle, or the handle may be above, okay, the cycle point. Here it is, as you can see on this chart. I have one more example that I want to show you again. Here it is another stock, Milan. Okay, I did all the stock that I'm showing you here. The one I showed you earlier. Okay, this is Liberty Global Incorporation. All right, listed on the NASDAQ 100. Now I'm showing you Milan, Epic MYL. Okay, Mike Yankee Lima, listed on the NASDAQ 100. Here it is. Okay, again we see a bullish progression and then the price pull back. You can see that this is not perfectly round. Okay, it's not perfectly round. In fact, this is a good setup because the price went down. 1 to 3 minimum price move. 1 to 3. If it's changing direction, it's going to go fast. So you see here, price went a bullish progression and then it came down. 1, 2, 3. All right, get it? Okay, 1, 2, 3. If it goes down 1, 2, 3, after a bullish progression, turn around, join them. It's going to go up. You see how the candle went fast here? Boom, 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 up. But before I forget, my friend, when we see the cup and handle chart pattern, okay, it is not a trading signal, okay? It is not a trading signal. It's a trading setup. We will use a top-down trading method to trade it. Traders that are using option, well, use your call option, but if you combine option trading with a top-down trading method, you will time, okay, your call option, the time you buy your call option at the right place, which is right here, somewhere here, using a top-down trading method. So once we see the cup and handle chart pattern, the theory stated that once the price is out of this declining channel of the handle, trader must buy. I say to traders, use a top-down trading method to trade it and pay attention to the economy news and do not assume that when the price goes up and form a cup and handle chart pattern, definitely the price will go up. No, the price does not go up, does not have to go up. All right? If the fundamentals are weak, The price may go up as you see here and see a cup and handle chart pattern, and the price will come back down. Okay, so do not assume anything. Check the fundamental, combine the technical analysis with the fundamental, and most importantly, as a technical trader, use a top-down trading method. Okay, so here it is. You see bullish progression. It's not perfectly round bottom. The theory stated that this theory was saying that it must be perfectly round. Here it is, 1, 2, 3, and then it goes up very fast. Yes, this is a round bottom with a handle, a cup and handle chart pattern with a handle. See here, we measure, okay, the depth up to this point. This is my measuring stick. All right, here it is. We project it at the top of, okay, the cup, which is now a round in this case. All right, and the handle, you can see if we use Fibonacci retracement level, you can see that, okay, it stays, okay, all right, where is it? Above the 61.8% Fibonacci retracement level of the height of the cap. In fact, the price stopped at 50% Fibonacci retracement level of the height of the cap. You see now? It makes sense? All right. Now, as the price goes above, okay, a lot of traders will say to me, John, they set a target from the handle as it break out here. So some traders will set it like this. Remember that not all traders are trading the same way. So some traders will set it like this. That's why some trader came out here. Okay, you see this one here. But my recommendation, above the neckline, above the cycle point, that's how I use my cup and handle target. And this is my initial target. Now, we don't want to forget where is the midpoint. Here is the midpoint. You can see that even if you set it like this and pay attention to the midpoint, traders that set their target like this, you are likely to also catch some of your position at this point here. Okay, it makes sense. All right, my recommendation above the neckline and pay attention to the median line. Here it is. It hits the initial target and the final resistance there. Okay, and then start coming down. We can look for convergence signal if the price reach, okay, a target point. All right, so for day trading, swing trading, all right, we can look for convergent point, convergent trading signal when the price reach the target for the cup and handle chart pattern. All right, then if you receive a signal, we'll enter the trade at a low risk entry point. I have one more example, and then we will close this video today. I want you to see every example. That's why this video is long today. All right, what? So is this the most, okay, powerful bullish continuation pattern? Yes, it's one of the most powerful, okay, bullish continuation chart pattern. All right, it is formed, okay, all right, during a bullish progression. The ultimate place is during a bullish progression. Price goes up from A to B. All right, you see here again, this is another stock, Intuitive Surgical Incorporation, EPIC ISRG, okay, India Sierra Romeo Golf, listed on the NASDAQ 100. Here it is. We can see that there was a bullish progression, all right, and the price went up from A to B, and again, did not form a perfect round bottom, but formed, okay, the V pattern, followed by the handle, which is, okay, you can see the pullback again, okay, and we will measure, we place, okay, the cycle point here, and measure the height of the cap, okay, and see how far the handle, okay, retrace the cap, okay. So we'll use the Fibonacci retracement level once again here, from the bottom to the top, and we will see it went, is it above the 61.8% level. So we'll draw the 61.8% Fibonacci retracement level. If it goes below it, as I showed you earlier, we'll wait for it to go above the 61.8% level and form a higher low, and we'll take it from there. Here you see that it found a support at 50% Fibonacci retracement level. In fact, generally, very often, you will see that 70% of the time, the price will find a support above the 50% Fibonacci retracement level. All right, because the 50% Fibonacci retracement level is a psychological price level. Bullish traders do not want the price, they handle, to go beyond the 50% level. So if it goes beyond the 50% level, you may allow it to go back above the 50% level, because the 50% Fibonacci retracement level is a psychological price level. All right, my friend, I think I've said enough. So we are talking about, okay, the most powerful bullish continuation chart pattern, in this case the cup and handle chart pattern, or the round bottom chart pattern, all right, or the V chart pattern with a handle, and the pattern is formed during a bullish progression when a price will form a cap, which is a round movement from A to B, and then with a handle when the price pull back a little bit to form a handle. The entry point is the bullish trading setup is when the price break out of the handle. Trader will use a top-down trading method to trade it. This is the theory. But as I explained to you sometime, as I show you already, we have seen a case where the cap and handle chart pattern is being formed at the end of a downtrend, because according to the market stable data, a bullish chart pattern is formed at the support level at the end of a downtrend and during a bullish progression. If you have any question, put in the comment section, and in due course I will record another video to explain or to answer your specific question. I will be recording more videos when I will be using chart pattern for day trading, for swing trading, live day trading, live swing trading, to demonstrate to traders how they can use the cap and handle chart pattern like a professional traders. We wish you the very best in your trading, and until the next time, enjoy yourself and be very happy. We are the TSTW24 traders talking about, is this the most powerful bullish continuation chart pattern? Happy trading to you all, and speak to you soon.